Hi, this is Craig Haskell with the Value Hound Academy. You're listening to another exclusive interview with the leading authority in the syndication of value-add real estate. You know, one of the big mysteries confronting syndicators is how to start a real estate fund. Yeah, a fund that allows you the discretion to buy real estate assets without asking for investor approval. Starting the fund is not for everyone, guys. It really isn't. But it's a great financing vehicle for those in the transition to more capital flexibility. Well, I got to tell you, I'm really excited because we have a very insightful interview with Matt Burk, co-founder and managing principal of Fairway America. Since 2001, Matt has raised multiple funds that invest in real estate. And you know, a few years ago, they opened up their business to provide advisory services to help others through the process of starting their real estate fund. And you know what? In this interview with Matt, you're going to learn the process to starting a real estate fund. The 3 biggest mistakes new syndicators make when starting their fund. How important is experience and track record? What types of fees and back-end profits can a fund manager expect? Best places to raise capital for your fund. And how much new fund managers can typically expect to raise during their first year. Guys, right now Matt is in the game with his own real estate funds, as well as he's helping others like you get started in the real estate fund business. I got to tell you, wouldn't it be nice to have funds sitting in a bank account ready to invest when you had that great deal, that perfect deal? You know, if that's for you, then I encourage you to spend some time consuming this very unique interview. All right, Matt, thanks for getting on the line for us. I really appreciate it. The fund business is, to some people, it's a little bit mysterious, especially to the small syndicators looking to roll into starting their fund. There's a lot of us Value Hound members that are thinking about starting a fund, and I wanted to ask you how you got started in the fund business.
Well, I really got started in the private money lending business back in the 1990s, and in the early days we were doing whole loans, so matching up one investor, one loan at a time. And after a while, that got cumbersome, so we actually did what a lot of the syndicators and private lenders do, and that's fumbled our way through it the first time we did it. So I tackled the whole fund concept back in about 1999. It took me a couple of years to figure out how to put it together and all that, and did our first fund in 2001, and since that time I've done 7 funds, and back in about 2011, when the sort of tail end of the downturn and people kind of getting back into the real estate business, I had a lot of people coming to me asking for some advice and guidance about, hey Matt, I know you've done a lot of funds, and well, can you tell us how to set one up or give us some advice? And after about the 4th or 5th one of those, it occurred to me that there was a lot of people out there that really needed that help, and we launched the advisory and consulting platform to help people set up their own funds back in late 2011. So it's been just about 3 years now, and that's really how I got in. So I got in it as a practitioner, doing it myself.
Yeah, doing it. And you said you fumbled your way through your first one, and that's what I teach everybody, their first syndication. It's just a process of learning. Anything you do in life, the first time you're going to make mistakes, and so. Well, I'm actually on your website right now, Fairway America, looking at it, and really nice site that has a lot of information. I wonder if you could tell us about your company, Fairway America.
Yeah, well, we're a number of things. We're an advisory and consulting firm, so essentially what we do is take all of the things that we've learned over all these years doing all these funds, and we help other people, avoid a lot of the mistakes and do things much better from the very beginning. So the advisory and consulting platform, we help people put the funds together, organize them, conceive of them, structure the asset model, and launch the fund. We do back-end fund administration, so once the fund is up and going, we help the fund manager deal with sort of the mundane aspects of running a fund, share price calculation, financial statements, and all the administration that most deal people don't particularly like doing anyway. And then we are and continue to be a fund manager. We have 2 of our own proprietary funds that we manage that have 2 different asset strategies, but we invest in other small balance real estate funds and syndications and mortgage loans all over the country, for people that are in the small balance real estate.
All right. Well, I know that there's some of us that may not know what a fund is. So I wonder if you could share what a fund is and generally how it's created.
Sure, and I would say that there is confusion about that out there. I define a fund as a pool. It's a pooled investment vehicle, meaning there are both multiple assets and multiple investors. And the key to it is a fund. It has to have both, right? So pooled assets, pooled investors. And another characteristic would be that typically the fund is discretionary, meaning that the investors are not picking and choosing which deals they're investing in like they would do in a syndication, or on a whole loan model. They're investing in a fund, and the manager then has control over which assets it picks and chooses. So at the end of the day, a fund really is just a capital structure. It's a different way of raising capital for the deals that people are doing. Syndication is generally one asset, multiple investors. This is multiple assets, multiple investors.
And that fund could be either debt or equity?
It could be debt or equity or both.
Okay. Good. And so generally, how's it created?
Well, there are several versions. I mean, what we see most commonly is called a 506 Regulation D fund. And the fund it does not have to be registered with the SEC. There are various exemptions from registration that the manager can use. And the actual process of creating it really is I mean, there's a lot to it, but fundamentally it's, creating a set of offering documents that describe what the fund is going to do. But just creating a set of documents doesn't, I mean, technically somebody then has a fund, but it doesn't necessarily mean that they can actually, go raise any money. But it's not particularly hard to create the fund. What the hard part is setting it up properly and dealing with all the nuances of it.
Right. And now you guys specialize in what you call small balance real estate funds. What is small balance?
Well, we define small balance as any real estate asset-based strategy where the average deal size is below $5 million, and frankly, Craig, most of them are below $1 million. So that could be a, guys syndicating, fixing and flipping houses, buying distressed debt, making hard money, private money loans, doing tax lien certificates, anything where real estate is the fundamental underlying asset class that backs the investment, and the average deal size is below, let's say, $1 million.
Yeah, so smaller type stuff.
Mm-hmm.
Yeah. Okay. So
which, by the way, constitutes the vast majority of deals in this country. I mean, there are,
absolutely.
What gets all the press are the big, shopping malls and downtown office towers and things like that. But the vast majority of deals are, the small balance real estate.
Okay, cool. Well, Matt, let's actually talk about how to set up a fund. What's the process that one would go through and that you guys go through with your clients?
Yeah, and as well as I say, it depends on who you're dealing with as to the process. But the most often the process is people call up an attorney, and if that attorney has some securities pedigree, they prepare a set of offering documents, and the manager has some documents, and they have a fund. But that's really not the best way to do it. The process that we go through is very different. I mean, we start with the asset model. What type of assets is this manager, this syndicator, the sponsor doing, because that drives how the structure should be set up in the first place. So we start with the economics and the structure based on the asset model, and then we build a capital structure around it. And there's this whole sequence of things that we put people through to help them understand, why they're doing what they're doing, why they're setting it up the way they're setting it up, and try to create something that actually matches the capital structure to the asset model.
And I know there's a lot of people that just think, gosh, I just like to do my one-off deals versus doing a fund. So tell us the advantages, some of the benefits of using a fund.
Yeah, and I will tell you right off that there are a lot of times where people call and we chat with them. By the time I ask some qualifying questions, the fact is they are better off just using a syndication model. So it really does depend on, the individual and the temperament of the individual and whether or not they're right for a fund, as well as, the asset model, the frequency with which they're doing deals, and so forth. Assuming that the asset model and the manager are conducive to a fund, then there are a great deal of advantages to it. The primary one of which, in my opinion, is that it allows the sponsor, the syndicator, to systematize their capital raising component or function of their business in a way that doing deals one at a time simply doesn't. As you're doing deals one at a time on a syndication basis, I mean, every single time you get a new deal, you got to put some material around that particular deal, and then you got to go out and hustle and raise money from a number of people for that one deal. Well, if you're doing 5 deals a month, that's a lot of work, and every deal is different, right? It's a different piece of property with different characteristics, and it's not fundamentally conducive to developing systems around processizing, right, or systematizing, I guess is a better word, the capital raising function. Whereas when you're raising money in a fund format, you're selling the same investment over and over and over again. I mean, every investor is buying the same deal, right? So you're not trying to reinvent it every single time you do it. It just makes it easier over the long haul.
And when you're setting up the fund, it's kind of a blind pool, so to speak, right? You're just raising a bunch of money, and then you have discretion to go out and buy properties as per your operating agreement, right?
That's correct. And now when I say it's easier over time, it's easier to develop systems around. It's not necessarily any easier to actually get people to write you checks, especially early on, for that very reason, right? I mean, they're in a syndication, the investor at least knows which property, the guy's buying and what the characteristics are, and they have a little more control over which deals they participate in and which ones they don't. Whereas in a fund, it is a blind pool, and the fund manager has discretion over picking and choosing the assets within some defined parameters, around a sandbox, if you will, of what type of deals they're going to do. But beyond that, the investor's not picking and choosing the individual deals. That is the single biggest, I'd say, challenge to the capital raise piece, is a lot of investors just don't, they don't want to give up control of the asset level decision making.
So let's talk about the best time to set up a fund. You think about someone's career, they're starting to get involved with syndication and starting to pool investors together. What would be the best time to actually start that process, start their first fund?
Well, certainly you want to have some track record, and you need to have done some number of deals and know what you're doing. So I generally always recommend to people that they do syndications, for some period of time to make sure they know what they're doing. But assuming you've been doing syndications, or in the case of a lending platform, making loans for some period of time, then I'd say, the Chinese proverb applies, which is, when it was asked, when's the best time to plant a tree? Well, the best time was 20 years ago, right? The next best time is now.
Right.
So there is, I hear people all the time, I'm going to wait for this and I'm going to wait for that. Look, if you're ready, if you've got the origination platform and you're doing deals, you might as well get it going, because even once it's up and going, it takes time to make the transition completely from the one at a time or syndication model to the fund model, and waiting generally, it doesn't do any good. Now, that wouldn't apply if you've only done 1 or 2 deals. I'd say, do some deals before you start contemplating a pooled investment fund. It's a whole different animal.
So I'm ready to start a fund. I'm really thinking about it. I'm working with you guys. What are maybe 3 or 4 of the biggest challenges I might have setting up that fund?
Well, if you're working with us, I will, being frank, you're gonna not make anywhere near the number of mistakes that people are likely to make when they're not working with us.
Right.
The biggest challenge to setting up a fund is by far matching the capital structure of that fund to that asset model, right? How are fees split up? What kind of pref should you pay? What kind of profit split is there going to be? Are there asset level fees that the manager should be charging? How much? Is it an open-ended fund or a closed-ended fund? If it's open-ended, how are you going to calculate the share price? There's all these things that go into it that people routinely mess up. An attorney's job is to draft a set of documents that comply with securities law. That's their job. Okay, it's not to advise the manager on all of the nuances of how the capital structure matches with their asset model. In fact, they don't view it as their job, and they've never had to run a fund, so they simply don't understand it generally. Although they'll produce a great set of docs. So that is the number one challenge in setting up a fund is getting it right from the very beginning. Once it's going, Craig, I'd say the biggest challenge is raising capital. But unfortunately, for most people, the biggest part, the hardest part of raising capital is that they had a bad structure in the first place. And I'd say the third challenge of setting up the fund is, how are they going to do the back-end fund administration, and can the fund even be administered the way that the documents are written up? And I see that happen all the time. The docs are written up, and what they say they're going to do in the documents is they're not capable of doing without developing customized software that they don't have, and they can't buy off the shelf. And there's all these mistakes that people make, and many of which, or all of which, they're going to avoid if we're helping them through this process.
Yeah, it makes sense because making mistakes is costly. So having someone there for sure.
And all these things, man, these are things that these are mistakes that we've made, right? I mean,
been there, done that, huh?
That's exactly right. So
yeah. So you said that fundraising is a challenge, and so I'm worried about maybe my track record of having some sort of success raising my fund. And so, what types of track record are important to have success or more success raising money?
Well, I think you should definitely have a track record of having done, some significant number of deals, and that will be different if you're doing, $50,000 loans versus, $5 million, acquisitions of commercial properties, right? As to what constitutes significant. But I would say you want to have been doing it for some number of years. You've done some successful deals. You can point to, we acquired this, we did this, we disposed of it at that, and here was the profit, and be able to point to that. And one thing I would tell people, if you're doing syndications, track exactly what you're doing and track it over time, so that when someone asks, when you're doing a fund and they ask you, show me your track record, you actually can produce, in summarized form that's meaningful to the reader, what they actually did. And I find many of the people that come to us cannot produce that information. I mean, they've done some deals, and they can verbalize how many deals they've done, but they can't produce something that actually shows me, what they've done. So track it. Really, when you go into the fund is only a capital structure, right? It's most people that are doing a fund, they're going to be doing in the fund the same kind of deals that they were doing prior to creating the fund. So you should be able to extrapolate your track record of your individual syndications to the fund and make some reasonable projections if you actually track all that stuff and can produce it for somebody. But 3 to 5 years probably-ish in the business, for some a little less, for some a little more, and a reasonable number of deals under your belt that you can show to investors that you've done. And of course, you didn't lose a ton of money. Hopefully you made a ton of money.
One of the pool of members that we have, a decent-sized pool of members that we have at the Value Academy are real estate professionals. Maybe they're property managers, they're real estate brokers, they're attorneys. They're some professional. And what kind of track record? Maybe they've never done a syndication. Could they actually start a fund with some success they had in their real estate professional career?
They could, but I would say I'd be very apprehensive about that.
Okay.
I'd be very apprehensive because one of the things that, in my judgment, you need to have a successful fund is an ongoing origination platform. I mean, you have deals come to you on a regular basis. You either have a staff that produces them, or they come to you somehow. And if you're somebody that doesn't have a consistent stream of deals, there's no reason to spend all the money putting a fund together and having this more complex capital structure. If you're only going to do one deal a year, you might as well just do a syndication. It's easier.
Right on, man. So I've got a decent track record. I want to go out and start sourcing funds to raise money for my small balance fund. What types of sources? What's the typical capital source that I'm going to go after? to raise funds?
Oh, the vast majority of these small balance real estate funds and first-time fund managers are going to be just your high net worth accredited investors, a vast majority. Ideally, you're targeting what I call the passive high net worth investor. So in a lot of cases, the people you've been dealing with who've put money in your syndications will not make the leap to the fund model because they now it's different, right? And if you've been successful and they liked it the way it was and they got to pick and choose which deal they participated in, getting them to make the mental leap to putting money into a blind pool in which they now have no involvement in the asset level decision making can be hard. Some of them will make the leap because there's trust factor there, right? But a lot of them will not. So I target the passive high net worth accredited investors, the people that don't really want to be involved day to day in the decision making. They just want to find a good, competent, capable, trustworthy manager that they can put their money with and just sit back and collect the checks. Some of these funds, I would say, can get more institutional sources, but generally not the first-time fund manager. Family offices and pension funds and foundations, endowments, and bank credit facilities, and things like that are available, but generally only to to bigger and more experienced, bigger funds and more experienced managers.
So a little bit less risk. Yeah, a little bit less risk there, I'm sure. So I'm going to have a harder time on my first fund, like everybody does, raising the fund. Typically, what are you seeing for the first fund, the size of the raise?
Again, depends on the asset model and the average size of a deal. I've seen them as little as $3 to $5 million, and can be very profitable. And I've seen them as high as $100 million on the very first fund. But I would say 15 to 50 is probably a good range, and 20 and 25 would be a sweet spot. And by the way, when people, I tell people this all the time, clients, we have this discussion, repeatedly. When you first launch the fund, expect that it's going to take a little bit of time and continue to do syndications, once you get the fund up and going. The fund would generally get first crack at any deals that come through if it has the capital at that point in time. Right, but back to my question about when the best time to start a fund is, that's why you start it sooner than later if you're going to do it, because it is going to take time. So while you're raising capital for the fund, you get a sweetheart deal that you want to do, but you don't have the capital in the fund, you can still syndicate it, right, with your regular group of people, and you just make, so there's a transition period over some time. It doesn't just go like from syndication to fund. It's like syndication to fund while you're doing syndication to eventually, if you do it really well, doing funds only and no more syndications. But that might take 3 years or 5 years or whatever.
So that was the next question. Is the follow-up was, okay, so I'm just getting my first fund. Let's say I was going to raise $15 million fund and continue to do syndications. How long should I expect that to take on average?
15 million on average. That is a broad generalization, right? But
yes.
That could be 2 to 4 years. I'd say the most successful fund manager that we've had in the last, say, 18 months raised $20 million in their first year. A lot of them, I would say, in the first year, and I consider this to be pretty good. And again, this all depends on, your average size of your deal and so forth. But, 5 to 10 in the first year is not bad at all.
Okay. And so, a lot of the syndicators, we think about fees, we think about the back end, the carried interest. We kind of have an understanding of the types of fees we can take as syndicators, and I'm not so sure if they're different or the same in a fund arrangements. I wonder if you could share your experience with that.
They are different, and again, it depends on the asset model. There's really no one correct answer to what kind of fees and carried interest can you get. It needs to derive from the nature of the assets being originated. That's a big part of the art of creating something that can actually attract capital in the first place. But if I want to give you some sort of again, broad generalizations. You generally on acquisition of real estate type funds, you'll see the manager charge some sort of acquisition fee, and that can be 0.5%, maybe to a couple percent. They'll charge property management fees, so charge a percentage of the rents being collected.
Yep.
That might range from 2 or 3% up to 6 or 8%.
Mm-hmm.
Some fund managers would charge a disposition fee, so they charge 1 to 2% of the sale price of the property. Although, a big part of setting the fund up right in the first place is that the fee structure should balance, the practical needs and overhead of the manager in
Right.
terms of making it, feasible for them to run their business and make it financially attractive for setting the fund up in the first place if they're successful. Balancing that with the requirements of the investors who rightfully expect, good returns and, more importantly, proper alignment of fees. I mean, they don't want to see the manager charging a fee for this and a fee for that and a fee for the other thing. Fee going in, fee coming in, fee going out, and a fee to manage it, and then, oh, by the way, they sold the property for a loss and the investor lost money. Okay, so that's where we have to be very careful to set the fee structure up where it aligns in the first place. So a good example would be on a disposition fee of the property. I would rather see the manager charging the disposition fee as a higher percentage even of the net gain of on the sale as opposed to just a percentage of the sales price.
Right.
And then there'd be a management fee usually, which is just a percentage of assets under management, and that might go from, on average, say 1 to 2%. Usually they'll pay a preferred return to the shareholders. It might, depending on whether you're dealing with core product or value add or opportunistic, it might range, say, 6 to 10% on the preferred return. And then
Right.
above the preferred return, there's a profit split, anywhere from, investors would keep, ideally it's, 80-20. You get a lot of pushback from investors when you start getting less than that, but I do see plenty of people doing 50-50, 60-40. And some of that depends on how much you're, pulling off at the asset level. The more fees you're charging at the asset level, then the more percentage profits you better be giving the investor on the back end, because, there's got to be something in it for everybody.
Well, let's talk about the back end. What are typical back end splits?
Well, as I say, it can go anywhere from 50-50 to 80-20 in the favor of the investor would be what I'd say would be a range that I think is pretty prevalent. And that said, I've seen it above the range and below the range, but that's a normal range.
Well, I know the typical business model, as typical goes, for hedge fund managers is 2% asset management fee and 20% of the annual profits. And so I was just curious how the fund would set up, and it sounds like it's somewhat similar to a typical syndication.
Well, it would be similar, although if you look at these hedge funds, I mean, sometimes they're charging asset level fees, sometimes the devil's in the details. So you hear all the time, 2 and 20, right? Your typical 2 and 20 hedge fund. But when you read the documents and you figure out what they're charging along the way for collecting rents, for example, they may charge a 2% asset management fee, but they're also charging, a 5 or 6% charge on the rents being collected along the way. So I would just say the optics of the split confuse people all the time, both investors and managers. And many times they're just going off what they heard somebody talk about, but they're not really comparing apples to apples. And that happens all the time.
Okay, perfect. Well, what's the number one? What's the biggie, the big mistake that sponsors make when they're actually starting their fund, their real estate fund? What's that big mistake? Common one.
Bad structure. The sponsor doesn't know how to set it up, and the attorney is focusing on the legal issues, and it's just the economics are not aligned. I mean, it's bad structure right out of the gates, and it's very prevalent. And the vast majority of funds that I see, clients that came from elsewhere, don't raise any money or raise a tiny amount of money, and as soon as they have to go outside of their circle of influence and the people who trust them implicitly, then raising money becomes hard or impossible because the structure is just screwed up. It's an epidemic.
Well, for those of the people that are members of the Value Hunt Academy and consume our information, and there's many that are considering starting a fund, what advice would you give them as they get started?
Well, do your homework. I mean, learn exactly what you're doing. Understand that a fund is just a capital structure, and make sure you understand the issues that go into creating a fund in the first place. So I think A fund is not for everyone. In many cases, on real estate syndications, a fund is really not worth doing for a lot of people. So I've seen people pay a lot of money to attorneys to set up a fund where they really never should have done it in the first place. So a lot of syndicators are better to just syndicate, depending on the size and the frequency and kind of the life cycle of their deals. If you have high velocity and you're doing a lot of deals, you're probably a pretty good candidate for a fund. If you're only doing a few deals here and there and they last a long time, your strategy is to hold for 5 or 10 years or more, then you're probably not a good candidate for a fund. So just do your homework, I guess, is what I would say, and that can be hard to do, right? I mean, that's why we have the business model we have, is that we provide that kind of information, and it's not easy to come by.
Well, that's why we have people like you who help people set up funds, and so you do that. So how do you help folks set up funds? What's kind of the process?
Well, the process of doing it is that we walk people through the entire spectrum of setting the fund up, and as I've pointed out several times, we start with the asset model. So we interview people and figure out, okay, what kind of deals are you doing? What are the characteristics of those deals? I mean, when you buy them and sell them, and what are you trying to achieve? What's your typical deal size? How long does it last? And we literally start with an interview to figure out what the asset model is. From there, we'll build a financial, a capital structure financial model around that asset strategy and start with the economics. Then we turn it into a structure, and then from there we start drafting, term sheets to figure out what some of the characteristics of the fund look like, and then ultimately we engage, we subcontract out with legal. So we quarterback the whole process from start to finish, including, we hire the attorney on behalf of the fund, to sign off and represent the fund from a legal perspective, but we walk them through all of the business and economic points, the alignment and the structure of that fund, and then ultimately we can do the back-end fund administration once they get the thing up and going. So, it's about a 45 to 60-day process, generally, start to finish, depending on how quick the sponsor can digest the information and figure out what it all means, and but we try to make it easy for people. It can be like you said at the very beginning of this conversation. It can be a little daunting for people, and I know that from firsthand experience. So we try to walk them through just step by step.
I hope you enjoyed this interview. For more information on Matt Burk and Fairways America, please call them at 503-906-9100 or visit their website at fairwaysamerica.com. That's Fairway America.com. And if you want more training on syndication, then I encourage you to dig deep into all the valuable resources we have at the Value Hunt Academy. It's the site for free syndication training of value-add real estate. And finally, if you're at a point in your real estate career where you're ready to take action, you're ready to step into change and start building your own wealth through syndication, then let's jump on the phone. Let's talk. All you got to do is contact Nikki, and her email address is nikki@valuehuntacademy.com. And let me spell it for you. It's nikki@valuehuntacademy.com. And what you do is you're going to send her an email and ask for a call with Craigie Boy. So for any of the questions, comments, or ideas, please email me at craig@valuehuntacademy.com.